Hi everyone, hope you're doing well. So just do a longer video here. I'll just talk about kind of, I suppose, like the importance of investing and how you can make money from both investing, which obviously always carries risk, and it's not financial advice to do that, and also I suppose safe alternatives that they won't be as good as investing, but they'll give you, I suppose, boosts that are far better than just keeping money in an account and getting a little bit every month from it. Before we get started, if you do like the content, please consider liking, subscribing, and following, and that'd be really helpful. And just let me know in the comments if you want me to cover anything else. Right, so we'll get started. So I've done some videos about this before, but even at the 5% rate, which I'd say most banks don't pay now, Trading 2 and 2 do still pay over 5%, like 5.17% AER, but most will pay below this. Even if you've got near 5% and Bank of England rate is holding at say 4.75%, if you're getting 4.5%, say, probably just going to be losing money in real terms, even if you kept it in there for a year. If you have the average amount of money for someone in the UK who's, I think, less than 35 is about 3,500, that kind of level. So in a full year, even at the around 5% level, it's £180. And I've mentioned on some of my recent videos that I'll try and link to here. If not, just have a look at the page. You can easily get £200 by switching your account to at the moment, like Lloyds Bank, or there's various other banks that have offers 175, 180. They do kind of stop them abruptly, and they won't give you notice about that. So if you've got a current account that you've not switched to their I suppose chain of banks, so like or group of banks, just be aware that you can't switch from, say, Halifax and then switch 6 months later to a Halifax group of banks. So just be aware of that. But if you haven't switched to a group of banks already, you can get £200 easily from that. And then you can also look at the perks. And obviously this is safe money, right? So it's £200 tax free. And it's if it's better than your bank, you're also maybe getting better interest rates. If you've got an account that's like less than 1%, the high street banks aren't necessarily the best for interest, but it'll be a lot better than that. So depending on how much you've got in there, that could be another £100 you'd make in a year on top of the 200 you get from the switching. And it's quite easy to have a combination there of short-term safe money and, I suppose, fairly longer-term safe money over a year or something. They do also offer lots of other products. I think if you want a stable ISA rate, have a look at your high street bank. They're sometimes not as high, but they are stable, as in they're fixed, so less flexible. They're not going to be as high as the chips or the Trading 2 and 2s or those kind of ones generally, but those are variable on those sites, so they're higher rate but variable. So as interest comes down, they will be dropping. Whereas if you get fixed one, you may end up being better off, but you just have to have a look into that, because it's not financial advice, but just something to think about. And then there's also perks that banks do that can end up saving you a fair amount of money. So as you've probably noticed in the UK, a lot of activities are I suppose fairly expensive. So like with Lloyds, for example, you can get 6 free cinema tickets a year. You can get things like Disney Plus, etc. So if 6 free cinema tickets at £15 a ticket saves you £90 a year, that's, again, it's safe, it's instant, and there's no risk to it, unlike investing. So if you're going to get £100 more a year in interest, if you're going to get £200 for switching, and you're going to get a bonus like this that might be worth £90 to you, they do all add up. And obviously with that money that you've saved or received or what have you, you could always invest with that, because you wouldn't have otherwise had it. But also you just got to make that judgment yourself. It's always it's generally better to only invest with money that you're I suppose in a sense is disposable, just because obviously you can lose it. It could go up, could go down. So just keep that in mind. And obviously having things like expenses covered, rainy day funds, that kind of thing are also generally very good. Often paying down credit card balances is it can even be better than investing, because yes, historically you might get 8% back or what have you with S&P 500, say over the last 100 years or so, but if you're paying AER on like a credit card balance, you could be paying 27+% per year. So really paying off higher interest debt, which there's an argument for doing that with mortgages and things like that as well. But just something to think about. If it's not financial advice, but it's something to think about. And if you are going to go into something like investing, there's, especially around a kind of like Black Friday, there's often like cash back that you can get, even if you're only doing your normal buying, but also your normal kind of investing. Like if you're going to set up like a small pot, you can sometimes still get little bits of cash back. I know when I set up an ISA quite a few years ago, it was something like £150 bonus I had, and all I had to do was set up like a £20 or £30 a month amount in it. So if there's the sites like Quidco, Top Cashback, it's worth looking at if you're going to invest and you only have a small amount, looking at kind of whether you can get a bit of a bonus on it, because then you can just again reinvest it the next few months. If you're going to get £100 bonus and you're only going to put in £20 a month, that'll cover you for the next 5 months. If you leave it in there, that'll generally can go up or down, but investments tend to make fairly good returns over the longer term, 5 years, 10 years, etc. Just lots to think about with that. And then just again, with it being Black Friday, don't be fooled into always thinking that the prices you get will be lower. You can look at things like price history, and obviously even if you're saving money, if you're buying something that you don't need, it's not really saving. If you're genuinely buying things that you would otherwise buy, always look for cash back on them. So if you buy it with a credit card and get cash back, or if you can get a good credit card that gives you cash back on everything, and then bonuses on certain ones, that's always good. Assuming you can afford to pay it obviously at the end of the month, because there's no point getting 5% bonus cash back on a credit card and you can't pay it back end of the month, and you paid 20-30% interest on it. So take all these things into kind of account when you're making your own decisions. Not financial advice, but it's always worth having a look around to see, are there any easy ways to make some money that are safe, also if you don't really want the risk of it. And then also you can always look into a smaller amount of investments or the like, if you can afford it and you can be willing to take that risk, and go from there. So yeah, if you stayed to the end, please like, comment and subscribe. That'd be great. Bye for now.